Hey traders, Raghee here. Welcome to Charts and Coffee for Thursday, Taper Tantrum Thursday. Hope everyone is doing well. Great to see everybody. All right, so let's get to it. I mean, the big question I think on everyone's mind is this a dip to buy? Or are we looking at a more pronounced move to the downside? And so, look, here's the real answer. Nobody knows. Nobody knows. Now, the end of August over the last 5 years, from a seasonal perspective, does have a tendency to be choppy and then slightly bullish. Again, tendencies are not trades. And, as much as we know that could be what we get, I'm not anticipating that. In fact, again, here's a 10-year look, which a lot of folks are wondering, hey, is this how August is gonna move, or is it gonna be more along the line of the 5-year seasonal? But here's the thing that seasonals can't accommodate for. And that is, we just had the FOMC remind everybody of the obvious, which is they're going to taper. Taper tantrums are inevitable. No matter how well projected the FOMC has said what their actions are going to be in the future, or how far in the future they're actually going to occur, the market is going to hate any kind of reduction in the monthly purchases. Because look, as much as we want to talk about fundamentals and whatnot, and maybe even macro to a certain extent, one thing that we've always mentioned is the only macro that matters is the FOMC. And right now, these markets are not higher because of necessarily PE ratios and revenue. They're higher because rates continue to be low and the Federal Reserve continues to support. And it's not just the US central banks, it's central banks around the world that are doing the same thing for their equities. So, again, I'm not here to judge that. I'm just here to trade what I see. So what I see right now is very likely, and I do want to mention this because I've been talking about crude oil for some time. We had a nice trade in crude, we re-entered, and now this is finally really starting to break through the support at the lower end of the range. Now, if you checked out yesterday's free video at the Simpler Trading YouTube channel, I talked about all these levels, and I talked about the importance of distinguishing between choppy market entries in your book of trades and trending market entries. So I look at crude and then I remember, okay, this is a choppy market that I'm in, and the probability is far different than also this market that we are in. This is ZB, this is the TLT for those of you that might be in that. And this is a market that has far better trending clarity. So if you're looking at where your high probability trades are, and you're looking at all the trades in your trade book of trades, all the different open positions that you have in your accounts, always differentiate between what looks more like crude oil and what looks more like bonds. Okay. And then the other thing too is, if you follow along with the way that I manage trades here in Charts and Coffee, or when I'm in the rooms with you all, one of the things I talk about is being very vigilant about not having a greedy first profit target, rather being pretty prudent about it and moving to break even stops. And that's where things like Dropbox come into play, which is an open long position that we've taken profits on. That's where positions like Pepsi come into play. So once you've taken a profit, remember that fortune cookie wisdom in trading is don't let a winner turn into a loser. And how do you do that? Well, you don't have a first target out in the stratosphere. It should be pretty prudent. And then upon reaching that, you move the stops to break even, so that at this point, all you're risking is unrealized profit. All you're risking is house money, as it's called. So that's what I've got on my mind right now as we start off the morning. And I know I've talked in the rooms about this. Really interesting. This is the S&P, and I'm looking at the dips that we've bought in the past, and they look very similar. So if you're wondering, am I looking for something like this again? Not only am I looking for it, this is the really important part, I'm not allowed to do anything but take advantage of the dips. And by the way, since 4,100, yeah, it's worked out pretty well. So if this ends up being the one last trend trade, if I end up maybe putting on an aggro position between where we are in the S&P and the 55 exponential, and I get stopped out, it's a tiny sliver of a loss in an overall nearly 400 point move in the S&P. So always keep in mind, yes, there's going to be that one last trend trade, but a trend trading mindset, a trend following mindset remembers there is always going to be the retracement that keeps going at some point. But if you trade in fear of that, if you think you can avoid that, you're going to miss pullbacks like this and this and this along the way to that one last trend trade. So keep that in mind. Remember, trends do break, but if you're trading in fear of that break, you're going to miss gorgeous trend follows like surfing. The wave is going to end at some point. I'm going to reach the shore, but am I going to give up the ride up until that point? So take a surfer's mindset. All right. And what's really interesting is the average, the last three pullbacks, this being the fourth, it's a pullback so far, this being the fourth, what's really interesting is each one of these have been in the vicinity of 28 to 30 calendar days. Isn't that interesting? So I've kind of got these little measuring sticks along each in between the pullback to pullback to pullback. They've been in that 28 to 30 day. And here we are, basically the 31st day of, and yesterday was a 30th day. And so we're kind of right on that rhythm. I thought it was pretty interesting. So this is where we are on the S&P. That doesn't mean that we're going to see the same quality of pullback in the Nas, the Dow. We need to look at each individual index on its own. I do not believe the Nas is structured as well as the S&P, but then remember that the NASDAQ has, one sort of pebble in its shoe, and that's XLY. The S&P has strength in XLK, which I'd be completely open to buying dips in. XLF, which is actually doing pretty darn well after reorganizing into an uptrend. And finally, XLV, which is in fuego, and I would love to buy a dip at the 21 exponential in XLV. So the sector components of the S&P look better than the sector components of the NASDAQ, XLY being the bigger problem. All right, so question here. Hey there, Antonio. Question about the NASDAQ. It's currently below prior weekly candle 168. JT Multi is no longer double green. Let's jump on over to that NQ. But it was, right? So respect the trend that was. It's not bearish yet. It's just not as bullish. Remember, we have these incremental measurements of trend. It's not that binary. It's either an uptrend or a downtrend. It's, are we looking at as high quality an uptrend as before? And I agree with you. We do not have that. Can I explain the current condition? Yes. So I'm still bullish. I am. The weekly, look, we have not even touched the 13 exponential on the weekly, but we are below some key lows. So we are, there is some bearishness that could rear its head. We're not sitting at key support levels. Those support levels could be sitting below where we are right now, which means in this pullback, unlike 2020, where we could buy the broader index and follow all the boats and just jump into the tide, I'm going to be far more discerning on this pullback. So if you checked out the premium video, those of you in the futures room or the sector secrets room, I talked about getting in. Let me mention here in Charts and Coffee, what am I going to do here? I'm not going to look broadly at the NAS. In fact, I'm likely, although I like the S&P a little bit better, I will say, I'm not even going to focus on broadly on the S&P. Antonio, to your question, I'm going to think about XLF, XLV, XLK. And then we might even, once we hone in on a specific sector that we believe is a relative outperformer compared to the index, I might even focus in on an individual stock. So I'll probably stay at the sector level today, but I'm actually very optimistic on certain corners of the market that are holding their own pretty darn well. And it may not be an entry that I would consider as great today, because if we push the upper end of historical volatility, the DPMRs, daily price movement range, it would behoove us to wait for a minor low or inside candle Friday, right, tomorrow, and then that would actually make our first entry window Monday. So keep that in mind. If we push the upper end of typical price movement range historically, right? I look at a 6-month historical. That's the DPMR. That's the HPMR process that I created using historical volatility. If we push that, it's not aggro, but it's more moderate to conservative to wait for that pattern to occur. And then the earliest we could actually get in would be Monday. So that's a little bit more confirmation versus, maybe buying today's move to the downside. So thanks for the question, Antonio. Peter asks, my views on natty gas. So crude oil, definitely I would cut loose. Natty gas is going to be interesting. Now, energy, this has not been, as good as gold and bonds have been for us. Energy in this last group of trades, these are going to probably result in some paper cuts. And it's so important to not shy away, on this side of the microphone and camera anyway. It's really important to not shy away and sweep losses under the rug. We learn we're losses. What do we learn? Take a paper cut. It's easier to take small losses. And this is why I believed in fixed ratio or fixed bets, if you will. I don't mean gambling, but the notion that I'm going to look at a setup and say, oh, this is going to be the one that's going to be a bigger winner, or this is going to be the one that might be low probability. Number one, why would I take a low probability trade? I don't hate my money. I don't care how good the risk reward ratio is. If I'm going into a trade saying, yeah, I could lose, then why take it, right? That's number one. Number two is, for example, I think I've mentioned this before, at the onset of summer, if you would have asked me what I thought my biggest trade was going to be, I would have told you I felt it was going to be long crude. Wrong. What did it end up being? What was the monster trade of summer? We just kept rolling with and rolling with. It was healthcare. I did not know that. So this is where I say, are we going to delude ourselves into thinking not only are we going to pick the perfect entry, but we're somehow going to know what the better trade is going to be in terms of what is going to happen? The more that your trading requires fortune telling, the more that I've got to tell a fortune telling story for a trade, the more I lost my focus in terms of what it is I do for a living. And I believe that if you're looking at XLV, if you're looking at UNG, if you're looking at crude oil right now, yeah, our energy trades are probably going to result in paper cuts. And that means that when we've lost a certain percentage of the premium we've paid, I would definitely assume that most of the traders in natty gas are going to take the paper cut on the aggro entry. Moderate and conservative, depending on what you paid, you still might be able to sit through this trough, this dip. You might be able to, because this is not looking like crude. Neither is it the same type of market environment. This is more of a trending environment as opposed to crude, right? I will also, this is just me, again, I'm going to give you transparency, right? I will also recommend, I typically do not take my paper cut until after the clearing is over, which means after 10 a.m., I'll assess where we sit, where my premium, I'm already seeing the bounce in crude, right? So for some of you looking early thinking, oh gosh, this is probably not looking good. From those conservative fills, depending on where we are at 10 o'clock, might be a completely different decision. So I will wait for the clearing before I take my paper cut. But if at the clearing, I'm still at paper cut threshold, paper cut's just the small losses that I encourage traders to make. If I'm still at that level, just get out, right? It's unemotional. I don't take it personally. It's easier to come back, not just from a monetary standpoint, but from a mindset standpoint. It's easier to come back from a small loss. All right. So thank you for the question, Peter. Hey, James, good morning. At the open, my agro USO will be below. Am I still managing after the? Yes, I will still look to manage. But remember, our USO trades were what, $3 and change? So let me talk a little bit more specifically about the amount of loss we're talking about. I think this is really important. One of the other things besides paper cuts that we talk a lot about is cost per trade relating to risk and loss. We have, I think on average, I think our USO October calls were in the $325 area, $3.25 entry. My risk is this per contract. So one of the other great things about these ETF alternatives compared to the futures contract, one of the great things about the cost of these ETF alternatives is they're far lower. And that means our risk. Of course, this depends on how many contracts you have, but our risk is also typically far lower. I'm not usually, as a habit, I'm personally not in options more than $10, much at all. I like inexpensive options, and I think they're scalable. What do we focus on? Liquidity. So someone with a $100,000 account could buy 50 calls. Someone with a $10,000 account could buy 5, right? Scalability. If your approach at 10,000 is not scalable to 1 million, you don't have a sound approach. I know I'm not saying that in a definitive way, but that's my philosophy. The way you trade $1 million account really is no different than you trade a $10,000 account. Only the size changes, right? That's it. What most traders do is, as they get a bigger and bigger account, they start to bend and break all the rules and then wonder, wow, why am I trading so poorly? And I'm thinking, because you broke the habits that you developed or that you use in this smaller account. You suddenly figured, oh, it's a different kind of trading in 1 million. Believe me, gang, I've done the 5-figure, 6-figure, and 7-figure accounts. Heck, I've traded an 8-figure account before. The brief time I was managing some Forex funds. It's no different. It's no different, right? Only the size changes, not the methodology. So follow the rules, James. Those will be what will scale as your account grows. And I know you've been kicking butt and taking names. Take the paper cut, my friend. We'll bounce back. In fact, we're probably going to hit, depending on what ZB does, we're probably going to hit that 166 target for our long TLT, which has just been roaring for us. Remember, we have an 1804 target on gold after hitting the first target there as well. So remember, it's so easy to start to, what's the saying in traffic when people start looking at a traffic accident? Rubberneck. So easy to start rubbernecking the bad corners of the tricky corners, the negative corners of your account. Make sure you're focusing on where we're managing our winners. Dropbox Gold, TLT, Pepsi, so make sure you're managing those winners as well. And thanks for the question. All right, given the current pullback is possibly due to tapering, I agree, Line Watcher, full on tantrum. Am I still buying into the wave? Again, going back to what I mentioned before, Line Watcher, I'm going to look at the daily price movement range of these pullbacks. I'm going to look at the structure of the indices, and I might look at the index level. And if we do have those setups, you'll likely see me enter, say, the XLVs, XLKs, XLCs, rather than the SPYQQQ. I'll probably enter at a more granular sector level, maybe even a stock level. You'll probably see me do that. But if we want to be more prudent, and if we push the upper end of the daily price movement range, it will make sense to wait for a minor low or inside candle tomorrow, Friday. And that would make our very first opportunity to consider an entry Monday, which may not be such a bad idea. Don't be in a rush. Don't be in a rush. We're mostly on the sidelines, right? And we've got a few long positions in play, but most of them, luckily, are either going to be at paper cut levels today. Just cut it loose. I think I have to sneeze. Excuse me. Ooh, excuse me. Either going to be at paper cut levels today, or we're at break-even stops where, okay, no harm, no foul. We've already paid ourselves. We're going to protect our downside. So I'm not yet in let's get in the market right now mode, but I'll tell you what, when I look at S&P, I'm still bullish. When I look at NASDAQ or XLK, I'm still bullish. When I look at XLC, how can I not still be bullish? Yes, we're going into taper, which is probably going to be glacially slow. And yes, we're going into seasonally September, October, which is, arguably, whether you look at 5-year or 10-year look backs, it can be treacherous. So if there's going to be a more pronounced move to the downside, way beyond a pullback, but more like a more pronounced sell-off, yeah, we're probably getting closer and closer to that in terms of the calendar. But remember, what would eclipse that? If the Federal Reserve communicates a very gradual taper, I do believe this is largely going to be bought into, okay? I do largely going to believe it's going to be bought into. So thank you for the question. I'm not going into cash. I'm almost never solely in cash. I made that mistake once in 2008. I will never do that again, because remember, the way markets flow, something somewhere is going to benefit. Very seldom is everything going to be sold. This is where it is going to be important to see if the participation narrative turns into a rotation narrative. Yeah, I'll probably start looking at defensive. I'll look at aristocrats. I'll look at kings. I'll look at utilities. I'll look at staples. They still might move lower, but they're probably not going to move as quickly to the downside as high beta, high momentum names. So I will not go to cash. I don't believe in going to cash. I'm always going to have a place somewhere, because I know when certain markets are moving lower, others are benefiting. Hence our long in bonds, hence our long in gold. There are corners of the market. There may not be as many, but there are corners of the market that we can still look to put trades on. All right, gang. Thank you as always for being part of the Charts and Coffee crew. Let's be patient. There's no reason to rush into this. I think summer has been very good to us overall. So I'm not going to undo it the last couple weeks of August, okay? Which is really what the summer trading season has been reduced to. Low volume is definitely in the last 2 weeks of August. Be good to each other. I'll see you tomorrow.